lot of our audience, have been requesting that we actually focus on investment. We've been touching a lot of different types, but so today we're looking at, investment. If you want your money to grow, so we're going to be touching on what every Nigerian investor needs to know in 2025. And definitely, we have my star player, like I call him, Idika. It feels like a 3-man band whenever I'm around. So Idika, good to have you here again. And definitely, I know you're going to be shedding a lot of light for us on investments and all that. But before we even go in, right? What exactly is investment? A lot of people just feel, investment. But what exactly? Let's just put some definition to it.
Yeah. Good morning, Ogiva.
Good morning.
And Kayode.
Good morning.
It's good to be back. Yes. Like you said, investment is general term we use when we commit funds into an asset or into something else, either business, trading, when you commit money with expectation to get returns. That is actually what we call an investment. Because if you take money and put it under your pillow, and if it is not generating return, it is not an investment.
I'm telling you.
Those things you do where you put your funds with the expectation that it give you returns is what we call investment.
Okay, that's good. Kayode, invest to remove your money from under your pillow.
I'm investing in you now.
I like that. So understanding what investment definitely, so making an investment means actively, committing resources, in hopes of achieving a return, right?
A return. The most important thing, it must give you a return.
Okay, so let's consider, things to consider really before investment, right? I think that should be the next focus. So before putting your money, right, into any investment, what are the most important things?
The key things that you have to look out for. Okay. We have to look at 3 things that you must consider, which are the basic things. First of all, like I mentioned, the essence of investment is to get returns. And that is what we call pure interest rates.
Okay.
For instance, now you are investing 100,000 naira and you're expecting to get 110,000 naira, maybe in a month or in a year. That difference of 10,000 naira is your interest rate.
Yes.
That is the first consideration. What is the rate? What is the return I'm getting? But another thing to equally have to consider what we call the inflation premium.
Premium.
If you are expecting to get 10% and assuming that inflation rate increases by 2%, you have to factor it in. Otherwise, you have a negative real return. Now, if the inflation rate is expecting it to go, maybe increase by 2%, that means your interest rate should be what? Shouldn't be 10%, it should be what? 12%.
12%, yes.
Am I correct?
Yes.
So you have to factor in the inflation angle of it. Okay. That is the second one. Then the third one is what we call the risk premium. You have to
premium.
Yeah, you have to. The investment has to pay for the risk you are taking.
Okay.
Because it's not everybody. It's not all the time you invest in risk-free assets like federal government bonds.
Yes.
Now, if the federal government bond, for instance, is giving you 17%, then the risk premium you have, whatever you are investing outside that asset class, must give you return more than that 17%.
2%, definitely.
So you now add the 2% inflation. You now add maybe say, okay, depending on what you're looking at, normally in Nigeria now, the what we call the market premium rate is between 3 to 6%. So you have to add another 6% to that 19%. Then you're looking at 19, that's about 25%. So these are the things you have to consider. That means the return, if you're investing outside federal government assets, you have to targeting 26% return. So first of all, you have to consider the pure interest rate, which is the key thing your returns. Factor in the inflation premium and the risk premium. Basically, those 3 things you must consider them.
So definitely having a clear plan, and understanding your own risk tolerance are very key to this, right?
Sure. You have to understand but because that will affect where the asset class you put your investment. We have different asset classes.
Yes.
So your risk appetite will determine where do I go. So it's very, very important too.
Okay.
Which I have mentioned. That is the risk premium aspect of it. Always factor it in.
Risk premium and inflation premium.
Inflation premium and the pure interest rate, which is the normal thing you will get. Like I've said, if you are investing and you want, you are looking at, you invested 100,000 naira and you want to get maybe 110,000. 10,000 naira is the return.
Yeah.
So now that is the normal thing. But what of inflation rates? Assuming if inflation rate increases.
Yeah, you have to take note of that.
Take note of that.
Yes, definitely.
Now we assume that the first one we are investing in a risk-free asset, like federal government bonds or treasury bill, which we are sure definitely that you get it back.
Yes.
But what if it is not the asset class you are investing
yes.
and you are moving your money to another asset class? That means you have to factor in the risk premium.
Yes, you have to. You have
to.
In fact, it comes with it really.
It's natural. So these are the things. These are the things you have to consider. Otherwise, you will not grow organically. That's the reason why you see some people. Okay, I am just investing, and you don't see them growing organically. So you have to consider these things.
So Kayode, I brought the Tikako of you. Change your millions now.
So all my complaints.
Consider your risk premium and your inflation premium. Okay, so let's even evaluate, the investment value, right? How do you assess, the value of an investment before committing your money? Yeah,
that is very, very key. Very, very important. Otherwise, you'll just be wasting your time, and that's why even if you are trading, even those who are trading, those who own shops, you have to look at this value.
Yeah,
what is the value? What is the value? What is the interest value of what I'm putting my money in? You have to factor it. You have to get it. At times, that is where your financial advisor, your expert comes in at times to advise you. But you don't even need, there are certain things you just need to know in terms of valuation. What do I need, depending on the asset class? But I think basically all of them, they follow the same principle, no matter the asset class you are investing, and which is what we call discounting. The present value, the value of any investment is the present value of the expected cash flow from that investment.
Yes,
for instance, now
that makes sense.
Yeah, for instance, now you want to buy federal government bond. Then the price of that, the value of that bond is the present value of the expected cash flow of those bonds. Just like you are equally doing business and you invested, maybe you are trading. You are buying something and you are selling. The value of that your investment depends on the cash flow of that investment you are getting. But the key thing that most people don't do that, you have to discount those cash flow to the present value to actually know. And that is where the issue of that interest rate. At times when you see people experts focus on interest rate, you think that it doesn't matter. It matters because when you are discounting, it is that interest rate that you use to discount to actually get back your value. It is when you non-discount, you'll be able to know, fine, this asset is undervalued or overvalued. And normally the rule is that when assets are overvalued, you don't buy. When they are undervalued, you buy.
So you buy the deep, right?
Yeah. The essence of this thing is to find out what is the true value of the investment or where you want to put your money.
And if it's overvalued, you can't.
It's overvalued. Depending on the asset class. If it is overvalued, normally it's not advisable for you to buy an asset. But the key thing is that you always buy that is the price of what you are paying. You understand? Should be less, should be less than actually the value of that asset or investment.
Okay, so definitely taking a data driven approach will definitely aid you in making the right investment decision.
There are various ways you can really know the value. I've mentioned it depending on the asset class. For instance, if you are investing in stock, if you want to invest in stock, if you are putting money in stock, there basically look at what we call the price earning ratio, the price to book ratio, the price to sales ratio. The price to earning ratio just tells you, this asset is overvalued or undervalued relative to the earnings of that company. Now, if an asset, if the price earning ratio is about 4, it means that for 1 naira earning, that you are paying 4 naira.
Okay.
That is the meaning. You are paying 4 naira. It could be that, okay, you are expecting that this earning, the company did very well and the earning is going to improve. So you can decide to pay that premium because of expectation of growth.
Okay.
Now, if you look at the price to book value, you are now looking at, okay, for normally the lower the ratio, the better for you to be able to know this one is undervalued. Normally below 1, you say that stock is undervalued because if a price to book ratio is 0.4, for every 1 naira of the book value of the company, that you are paying 46 kobo.
Yeah.
That is what it means, and that is good.
Yeah,
it means that it's relatively undervalued. That is on the stock. Now, if like I mentioned the bond, if it is for bonds, then you have to discount and get the real value.
Real value.
Yes. If after discounting and the price you've gotten is less than the first value, let's say 1,000 naira, and after discounting you have 900 naira, that means that the thing is being sold at a discount.
Yes.
Vice versa. So these are the things you have to do to get the value. If you cannot do it, then you have to get a financial advisor to advise you to calculate, to work it out. Even if it is trading, you have to work it out to actually know what is the value of this investment.
Okay. That is really nice. I like the way you actually put it. So, but so we've identified. We will understand what investment is, right? Things to consider before investing and evaluating investment.
Yeah, you're getting the value of that.
Yes.
Of whatever you want to put your money. It's always very, very key, very, very important that you should do that. Yeah. Otherwise, you just be wasting your
time, really.
Your time,
your money, everything.
I don't know. Okay, you buy only to find out. Okay, I'm losing money, and that's what happens to most investors. They do that. So it's key that you must do that after establishing the normal thing. You must look at the value. What is the value of that investment? The idea is that you shouldn't be buying. No, what they quote like the stock and bond they quote is just the market price, but you need to get intrinsic value.
Okay, so with all this now, let's go into reducing, investment risk, right? Okay. Yeah. So what steps can I take, really, do you understand, to reduce risk in my investments?
Yeah, life is a risk too. So life is a risk.
It is really.
So everything you do, you take risk. But the most important is, how do I reduce the risk element of it? You have what we call systematic risk and what we call unsystematic risk. Those systematic risks are those ones that you cannot diversify. So the first thing is diversification. But there are risks that you cannot diversify, like the macroeconomic trend issues that you cannot diversify, like disinflation rate, exchange rates. Those ones affect every asset class. You cannot really diversify. But those are systematic risks where you can diversify. That's where diversification comes in.
Yeah.
Then you look at, okay, fine. How much do I put in bonds? Depending on my risk tolerance.
Exactly.
How well can I take risk?
How much can you put in?
How much can I put in? Then you can then say, okay, fine. Based on the peculiarity of the bond, I'm putting so amount of a certain percentage of my portfolio in bond. Then I put one to equity, then one to commodities, one to currency. But it is not good to put everything in one basket.
Yes.
So the key thing is diversification. Then the second one, they are hedging. There are ways you can hedge against risk, especially if you are an investor, you are investing in stock, what we call derivatives. But derivatives. That is a key. That is a form of hedging tool that you can use to hedge against the peculiarity of stock volatility. So those are that one. So you develop your hedging tool, how to manage those risks. Then you equally have to research and understand where you are going. That is a key thing. If I'm going into stock, I have to understand what stock is all about. If I'm going into bond, I have to understand what bond is all about. If I'm going to trade in a particular trade, I have to view the environment, look at it critically, the pitfalls, the strengths, the weaknesses. What do I have to get? So that you have to understand that before you start going in. So these are the ways you can develop in risks management, have a robust risk management. Okay, I've studied this asset class or these investments. These are the problems. These are the challenges. That will now help you to avoid them.
So definitely, I mean, managing risks, requires a lot of attention and adaptability, really.
Yeah, sure. It's just the key thing is just understanding where you are going and what you are doing.
Yeah.
You don't just that what we call head mentality. You just don't hear that, okay, stock is paying. Then because your friend has told you that stock investment is good. And it might not be within your investment objective, or you don't have the level of risk or the risk tolerance the person who invested has, and you just decide to, because he has told you that stock is actually doing very well, and you just jump into it
without your doing due diligence,
without even defining your own your own investment objective, looking at your age and all those things that come into play before you go in. So you have to really understand, what do I really want, and where am I going?
So I heard you mentioned age. How does age matter really in this?
It's very, very important.
Yeah.
Age is very, very important, because that will now define. Okay, let me come down now.
Okay.
Let us use the discount rate of issue now.
Okay.
Now, give as you are now. Depending on your age, your age when you are doing valuation, it equally affects the discount rate you. That's off.
I'm a Gen Z.
Yes. That is.
No, please.
No, I like your optimism.
That is off it, because if you are older, definitely I will use a higher discount rate.
Yes. If you are older.
Yes, to discount your expected cash flow.
Yes.
Whether you are working or not. Whether you are working, especially if you are working. Unlike somebody who is younger, normally, because I know he is going to likely to work longer, younger, and in terms of health, he's still strong. You factor in, those are the risk element, and that will now affect the discount rate. I will use now to discount his cash flow to actually know what is the intrinsic value. So your intrinsic value might be different from my own intrinsic value because of age.
Yes, I get you.
Because I can use a higher discount rate to value you, and use a lower discount rate to value somebody who is younger than you.
Yes, I get.
Do you get the point? So that is how age. That is of it. But normally, the younger you are, the more risk you can take, because you have the possibility of you recovering is much higher than somebody who is older than the person.
So I mean, definitely to the audience, time is ticking. The earlier the better, right? So
even if you start like now, if you are young and you start investing in stock, you understand you can recover. And the key thing is that always look for favor long-term investment. Like now the fintech has made it very, very much easier for people to invest in stock. You can stay the comfort of your home with your laptop and be buying. You understand? You can buy as much as 10,000, 20,000, 30,000 units on your own. So you can start gradually. You can start gradually to build.
Yeah.
Maybe you say, have a timetable. Okay, I'll be investing, let's say, 2,000 naira, which is something you can easily use.
Yes,
you can easily spend level.
Yes.
So they say, okay, I'll be buying stock of 2,000 naira every day. Multiply 2,000 naira a day times 30. You know how much it will give you, and then you will not keep it. You continue like that. If you are young, by the time you get to maybe say 50 years, you at least you find out how much you would have gotten. So longer term investment too is key, especially if that is where age comes in too. Do you get it?
Yeah. I get you. And thank you for shedding light onto that. I mean, so definitely for sure, age is one of the factors. So
very key.
Use the earlier the
very
better.
key. Even if you go to the bank to borrow,
they'll still ask you for your age.
There's age. You tell them. They tell you no, we can't give you.
Yes, true. Yeah.
Because they are afraid that the recovery rates, the chances of getting back their money
slimmer,
very, very remote and very, very slim. So age is very, very important. Age is very, very important.
I mean, it's good to know. I really appreciate highlighting that part. So with that, right? How would you advise, someone who's just starting to invest, right?
Okay,
Who just
young investors.
Yeah. So I mean, with your answer was more on the focus on the older side. So so for a young investor, really, what would you give? What advice would you give? To someone who just wants
start
to
slowly,
okay,
gradually. Know where you are going. As a young person, at least we are internet age where you can get anything you want. So you start gradually, slowly. Don't be in a hurry. But our problem is that we always want to make quick cash.
Yeah.
If you start in time to build and you follow through, then you'll be surprised by the time you get to a certain age how much you have accumulated. So the first thing for young investors is to start early and be consistent and gradual, intentional.
Yeah. Okay.
That is one. Second one, know where you are going. What is my objective? What do I want to achieve? It is very, very important.
Yeah.
Don't be interested in what other people are doing. What do I want to achieve? Then the third one, like I said, always know what you are buying. Yeah. Always know the value of what you are investing in.
Yes, you said that earlier.
Otherwise, you will not grow organically.
There'll be a lot of ups and downs.
Ups and downs, because if you understand it, like now, I'm expecting 10% investment, a 10% return from this particular asset class. I'll do my evaluation. What is the cash flow I'm expecting from this asset class?
Yeah.
Okay, the cash flow, normal monthly basis, is 20,000 naira. And I've invested, let's say, 100,000 naira. That's going to give me 20,000 naira on a monthly basis. Let's say for 1 year. Then I'll come back and now discount that 20,000 naira on a monthly basis for 1 year, including the principal amount. That is the first value. That will now give me an idea. At the end of this 1 year, this is how my investment of 100,000 naira, this is actually what it will give me. So that will now tell me, go ahead. And if the return matches my expectation, fine.
Otherwise, you skip it.
I skip it.
And look onto
other things and do other things. Otherwise, you just be wasting my money, throwing money here and there, carrying papers here and there. Okay, I'm doing this, and at the end of it, you see that you are not getting anything. So if you cannot do it, I've elaborated enough on how you can do it on your own. But if you cannot do it on your own, you get it's always good to get that. I've been saying that so that while you concentrate on what you are doing, the financial advisor will be there to guide you.
Yeah, I mean, great advice. Thank you very much for that. So definitely taking gradual steps, while building, definitely sounds essential. So so for all your listeners out there, especially from the younger generations, right? Please ensure to follow the tips Idika shared with us today. So with that, right? Definitely, we've talked about the idea of investment and how to apply yourself, right? So this is not an advice, for the public. I mean, if you need any financial advice in regards to investment, please ensure to contact your financial advisor. But so where would you? We've spoken about investments. Well, where would you invest right now? Especially with the economical changes and definitely everything that's happened so far. Where would you? I don't want to use the word advice, but where do you feel people can, with all these tips that you've shared, people can actually put in their money right now?
Yeah, that's a good question. But I think I look at it's perspective.
Okay.
Where you invest is relative. What I mean by depends on what you want.
Yeah.
I've said it, your investment objective, your age, what is your expectation you want to get. Those are the three things that can tell you where actually to invest. Okay. But give and take, the most important thing is to look at the return.
Yeah.
That is the key thing. Even though some people don't really invest for return, they invest for other things.
Yes.
But if it is the key thing for you is the return on investment, then you have to look at the asset class that can give you
what you want, your expectations.
Give you a higher return. And in this case, normally stocks are okay, but because of the high volatility and the risk inherent. So depending if you can take that, because I know that even if you look at the large published result and companies have declared dividend, you can then see what the shareholders are making in terms of dividend alone. So even right now, stocks in the Q1 stocks have even gained up to. See some stock gain up to 116% year to date. So if you calculate it, if you are putting 1 million, you can then see how much it will give you.
Yeah.
So on that note, it depends. Its perspective depends on what you really want.
Okay. Thank you very, very much, Idika. We're out of time here, but I mean, we really appreciate your presence. Well, I mean, definitely Kayode right now is going to invest a lot more money in me. And we thank you for that. And to our viewers out there, you heard what Idika said. So you identify what you want to achieve with your investment. Then you apply the tips that I shared with us today. So I want to thank you all for being a part of the show today. We look forward to seeing you next week. Don't forget to subscribe to our YouTube channel, and you can catch up with Everyday Money Matters on Spotify. Look forward to seeing you next week, everyone. Bye.
All right, and we say thank you for coming through, Ogiva Dika. It's another great...